It is my pleasure to welcome Harry Dent back to the show. He is the author of so many books. I started following his work back in the late 90s. Yes, it's been a long time. His most recent book, it's been a while since that's been published. It's called Zero Hour. We've had him on the show to talk about that in the past, but he's back with us again to share his latest thoughts on the economy. Harry, welcome back. How are you?
Nice to be back, Jason.
It's good to have you. You're coming to us from Puerto Rico again. And
Puerto Rico, I've been here for 8 years. I've never regretted it, but been coming here since 93. I had a vacation property
yeah.
on Culebra for many, many years and finally built a house there, which is far more difficult than I anticipated.
Oh,
but,
yeah.
but I finally moved down here when I watched San Juan grow from a second world city into a first world city. Then I said, okay, now I can just move down here because it's far better weather than Florida. Less cold in the winter, and we're at least 6 degrees less extreme hot in the summer, and that's where Florida gets tough,
Yeah.
is in August, September.
Oh, yeah. No question about it. Well, Harry, there's a lot going on with the economy. We've got this crazy political climate, too. Tell us just your macro view of things. You have been talking about a bubble for a long, long time, and so far the bubble has not popped yet. But what's happening?
Well, first of all, I mean, and this has never happened. This is not a long bubble. This is by far 3x the longest bubble before this. In other words, this has never happened before. And the reason is every bubble in history has come in good times, like the early 1900s, which turned in the roaring 20s. You know, when things get good long enough, investors and analysts and stuff just get all giddy and think, well, this is we've reached, as Irving Fisher said in 1929, the head economist there, a permanent plateau of prosperity, and people start thinking that way. And that's when stocks get overvalued and then they bubble and they crash. And then you end up in a Great Depression when all these financial assets go down and wealth is destroyed and, businesses laying out, all that sort of stuff.
So you're saying, unlike Irving Fisher, you are saying we have not reached a permanent plateau of prosperity.
Well, we didn't back then, but this looks more so because this has been the longest stock market run. I take out COVID because that was totally exterior and stuff. That just came and went. We were right back at new highs. 15-year boom without a real normal recession. That has also never happened in over 200 years of the stock market's existence. So the reason for that is very simple. It was only in 2008-9 when Ben Bernanke was the Fed chairman, who studied the Great Depression in the 30s as his thesis. When he saw 2008 hit, he was thinking like me. And I was telling people, we were predicting before and after, 2008 is 1930. This is the beginning of a Great Depression, a major bubble in financial assets burst, and a demographic surge in spending peaks and turns down and slows for a long period of time. And then you have a big deflationary deleveraging of debt, detoxing of debt, and asset prices come down. And that's the difference between a long or deep recession like in the 1970s or early 80s and a depression like the 1930s, or what should have happened, Jason, in 2008 to 2022, 23. Now, for the first time in history, again, you got to remember the Fed was only invented in 1914, had very limited powers, wasn't expected to do anything but just provide cushions in a short-term crisis, okay, to keep things from just going berserk. The Fed realized, well, we got the power to fight this damn thing. And Ben Bernanke, again, studied the Great Depression. He recognized it. Anybody else would have thought it was something different. He did see it. And he threw $1 trillion in the economy in 2009, thought that'd be enough. Okay, so did Mario Draghi over in Europe. No, not nearly enough, because it was a long-term crisis, and that's enough to get you through 1 year, not through 13, 14 years. So what happens? They had to keep upping the ante, printing more and more. And here we are, $27 trillion. Now, I'm the only guy that's counted this out and broadcasting it. 19 trillion of that is nonstop government, larger than average government deficits. I haven't had one surplus since 2001, okay? And $8 trillion of money injected directly in. That's what they call money printing. Well, spending deficits, because they just borrow these with treasury bonds and pay them back 30 years from now or something. All of these are creating money out of nothing and injecting it into the economy. So that's how we got the greatest bubble. Every bubble in history, again, has lasted 5, 6 years most. Late 24 to 29, late 99 to early 2000. That was almost 5.5 years. That's a typical how long a stock market can go crazy by itself in normal conditions in good times before the bubble gets so crazy it bursts of its own craziness. And again, that always happens. This time we've gone 15 years, 3 times. So it's because of the government, the nonstop and accelerating government, and this time fiscal stimulus has been 2/3 of it, 70% I'd say, and the monetary has been 30. Now, what happened is they finally overreacted to COVID, okay, 20 to 22. They, out of that 27 trillion I'm talking about, 11 of it came in the 2 years after COVID, and that caused this 9.1% out of nowhere inflation spike. And again, I got the best inflation indicator in the world, bar none.
What is that? Wait. What is that best inflation?
It's workforce growth. It is the cost of incorporating new workers in the infrastructures and new technologies they bring and require early on in this, before they become productive and earn and spend all this money they're going to do. That inflation comes in the early stages when people are entering the workforce. People think that high growth causes inflation. Our best growth periods in history, from the roaring 20s to the 50s to the 90s, had low or falling inflation. So I knew that wasn't the case from the beginning. So my research, I kept digging, realized no, workforce growth, and that correlated with the biggest 70s inflation in history. And that said that inflation would come down to about 1 to 2% in the 80s and 90s and stay there for a long time. Okay. And that's what was happening. We had this high growth economy with low inflation. But when COVID came, 11 trillion in 2 years, well, that suddenly caused 1% inflation to turn into 9%. And when that happened, oh my God, we got a tightened monetary policy, 525 basis points, the biggest since the last inflationary crisis was peaking in 80, 81. And I mean, that was the biggest ever, but it wasn't just the 525 basis points. They had run the balance sheet from 1 trillion up to almost 9 trillion. That's $8 trillion of money also poured in with these.
Okay. Harry, wait a sec. I just want to establish a few things here before we go. You're providing a whole bunch of information like a fire hose here. So first off, you said a moment ago, we were talking about the bubble. You talked about how the Great Depression happened in the 30s and, the Great Financial Crisis, 2008, et cetera.
After a bubble in financial assets, after the roaring 20s bubble.
So I just want to make sure the listeners understand, where do you think we are? Clearly, you think we're in a bubble, right? Correct me if I'm wrong. But
we're in an extended bubble. The natural bubble would have peaked already.
Right.
In 2021 was when the natural bubble would have peaked, and now it's extended even 3 more years out, greater. Because the government keeps fighting it bursting.
Sure.
Ben Bernanke.
Okay, wait. Hang on. Hang on a second here. So define.
So do you want me to bring in Mr. Rogers? I can do that.
Yeah. No, I just want you to define, what does that mean to people? We're in a bubble. The impression is the bubble's going to pop. And when the bubble pops, what happens?
Bubbles refer not to the economy as much, but to the financial assets, the stocks and the real estate that reflect the bubble. In a bubble, these things usually go up, but they go up in a measured way commensurate with the economy and earnings. A bubble happens when the economy goes up long enough and people feel good enough about it, and it keeps going up a little better, that people start saying, oh, well, this will go forever. And so now that's when they start bidding up the assets more and raising the valuations. If you never thought there'd ever be a recession or depression again, any asset you're investing in would be worth more today, because that's the biggest thing that destroys value down the road. So people get giddy in a boom, and that's what happened in the roaring 20s. It didn't happen as much in the 1950s, but it happened big time in the 1990s. We had a tech bubble, the first tech bubble, and that was the first real stock bubble, and very similar to 24 to 29. That was the first one since the Roaring Twenties. Bubbles are rare, okay? But now we've had two stock bubbles and two real estate bubbles, the first one on the lag, and now both together. So this is double bubble, Jason.
Okay.
Which is very dangerous.
Can you provide any opinions on time frames for us of when this bubble will pop and what that's going to mean to people? Like what will happen when it pops?
Okay. The time for it to pop really is in the current time frame, only because, I mean, you got to remember, this would have popped a long time ago. Government keeps stimulating, keeps upping the stimulus. Again, this 27 trillion. If anybody, any economist or any forecaster in the early to mid 90s had told you that we're going to have a big slowdown and governments are going to print, the US government would print $27 trillion out of thin air to fight it, people would have thought, oh, that'll never happen. Okay. That's how crazy this is. Okay. So a bubble happens when financial assets start to go up much faster than the economy would warrant because they're just thinking it's going to get better and better. And we've reached this permanent plateau of prosperity that Irving Fisher quoted in 1929. He quoted that right as the stock market was about to peak. Okay. That's what asset prices and the economy being good. People get delusional when they don't get their ASS kicked. Okay. Once in a while. And then you get a crash and you get a deflation to bring things, asset prices back down to reality. And that's painful when people are losing that much money. Banks are failing. They lend against all those houses and buildings. People lose money in their stock portfolios and then they spend less money. Oh my gosh, I got to work, so it causes this whole tumble down effect where one thing just makes the other worse.
Got it. Okay. So time frames, any opinions on time frames as to when the bubble will pop?
The worst bubble and downturn took 34 months from the top of the stock market to the bottom to crash. 89% unemployment went to 25% on a lag to that. That was the worst downturn, and that's as long as it took. So I'm saying if we're getting ready to peak here or soon, this downturn will take us probably into late 2026 to mid 2027. It's going to take at least 2 years. It may happen a little faster this time because it's been stretched so hard. But
I want to distinguish. That's when the downturn ends or starts.
The downturn starts soon and it ends 2 to 3 years from now.
Okay, so it starts what, next year?
I'd say the stock market could have peaked in July here, by the way. Real estate will tend to peak on a bit of a lag. Things should be falling the strongest in 2025, if I'm correct. And then they'll continue to kind of staircase down into at least late 2026 and probably into early to mid 2027. It just depends on how fast it goes.
Yeah, let's talk about real estate for a minute, since I'm heavily attached to real estate. And I would like to see a little bit of a price adjustment so we could have a more normal market. But inventories are still very low. Yeah. They're about half of normal. And people have been calling for a real estate crash for quite a long time. And I've been disputing that. And everybody's told me I'm too optimistic. I have a vested interest. There's a conflict of interest. And, I've been right and everybody else has been wrong so far. Of course, it's not going to, things will change eventually. But you can't create more real estate supply very easily. There's a real
but the average person also can't pay $1 million for a damn TP. Okay, it's
Fair
getting
enough.
there, Jason. But $400,000 for an average house in Ohio that was $100,000 just 20 some years ago.
I got it.
That's something somebody has to pay for, the interest and the mortgage.
Right.
For the same house. It'd be one thing for the same house.
Well, number one, you have to adjust that for inflation, of course. Right. So the dollars are less valuable.
Inflation has probably doubled in this period, but overall, this bubble's gone up 4x. Financial assets like real estate would have to come down 50% just to be in line with inflation.
But the problem is humans tend to just think, Harry, that because there's a trend line, you look at charts, right? That's what one of your expertise, right? Just because there's a trend line in the chart, that things have to move back to the way it used to be. I believe that something could become permanently more expensive. Nothing's ever totally permanent
in every era than the one before because, more people, more infrastructures, and generally the cost of living goes up. Partly, Jason, the real reason is we're always delegating more and more of the tax. I mean, the Little House on the Prairie, that guy, Michael, whatever his name, did everything.
Langdon.
You delegate and everything goes up, but you're specializing in what you do. So you may be making 3 times the income, but by delegating, everything may cost you twice as much. There's always inflation. Expanding new young people entering the workforce means you have to pay for those offices and infrastructures and training up front. And you get the benefit from that new worker getting more productive over decades, okay? So inflation always will happen, and it happens mostly when new people are entering the workforce. And that's why the biggest entry of new workers in the workforce was from the late 60s into 1980, and that's when we had the highest inflation. Had nothing to do with government deficit. They blamed it on government deficits back then, which was 90% wrong.
Okay, so back to the real estate thing, though. Look, housing affordability is the worst it's been in about 4 decades.
Yes.
It's terrible. Everyone would agree. But here's the reason that all the doomers got it wrong and I got it right. I think this is the fundamental reason. There's about 140 million housing units in the United States. When interest rates went up and prices were already elevated, housing became very unaffordable.
Yeah.
And the people that got it wrong viewed it this way. They viewed it as though, okay, a new entrant coming into the market to try and buy a house, it's very unaffordable for them. So that's naturally going to mean that demand will decline and prices will decline as demand goes down. But here's why they got it wrong. Because they didn't look at the tens of millions of people, about 130 million since rates went up, who control the existing inventory that don't want to sell because of their very, very cheap mortgages.
Right.
That have become an asset.
They cannot afford to get out of that mortgage. Yes.
Right. So because they control the inventory, it doesn't matter, even as demand has declined a bit, there's been demand destruction, prices have still gone up. I mean, supply side economics, right? It's the suppliers that mattered. There are tens and tens of millions of people that have very comfortable mortgages that ain't giving them up.
Jason, I'm going to stop you right there. Yeah. Okay. How do elections work? You know what decides elections? A tiny percentage of it, the swing vote.
Okay.
10, 20% at most. It's the same in economics too. Everybody can be doing everything normal and they're not going to change. It only takes 5% of people to just become all of a sudden net sellers or to get price out of the market. And then that starts it. And then the more prices go down, the more they go down. So that's the thing people don't miss. Yes, most people are not going to cause or trigger this crash. It doesn't take a lot of people, but people have to eventually sell these houses, whether they die or trade up to another one. And at some point, price alone will erase a bubble. And there's no bubble ever in history that has gone up forever and not crash. And no bubble that's gone up a lot hasn't crashed a lot. That's all I know. This may be the first one, Jason, and you and many people I talk to have theories of why this one will be permanent plateau. I'm telling you, I wouldn't bet 1 penny on a dollar on that scenario. Not even 1 cent for 10x returns.
I think it's pretty protected until one of two things happen.
Yeah, until something goes wrong. Exactly.
Well, hang on. No, not something go wrong. This is something goes right, actually. Until number one, we can create a lot more supply, or number two, we can create a lot less demand. Until those things happen, and real estate's very sticky, it's hard to create new supply of built real estate, right? Well, the one thing I always say, Harry, is that the one thing you must have, the one ingredient you got to have a real estate crash, is you have to have tens of millions of distressed homeowners that become millions of distressed home sellers. And right now we have the opposite of that. We have all these comfortable people that aren't in distress, right?
Let me tell you something else that can cause a crash.
Yeah.
A crash happens somewhere else. Can you think of some tiny little country over in Asia that has a real estate bubble that's already starting to fall?
China.
I've been preaching this forever.
Yeah.
That bubble makes ours look like peanuts.
Well, you're talking about Japan or China?
China. Well, okay, Japan's already. Japan's
gone through it for 3 decades.
When the rest of the world didn't, just because they got overvalued and their demographics low. There was none of this stuff you're talking about here.
Yeah. So that's
real estate got extremely overvalued,
to your point.
And then their demographics.
Harry, to your point, you made me realize more than any other economist because you study demographics. A major part of Japan's lost couple of decades was their demographic decline.
It
They had
was
a demographic problem.
almost all
The US
that.
has the opposite.
But it also is preceded by a bubble. A
Right.
bubble bursting makes
But
any
but the
downturn.
US has demographic
Depressions, let me
growth.
just get something straight here.
Yeah.
100%. When you see depressions in history, they follow major bubbles. When you see deep recessions, that just follows a boom. Recessions follow ordinary overexpansion of businesses and consumers and booms. It is depressions that follow bubbles because of the financial asset contraction that just makes it way worse.
Okay. So we'll agree to
And this is
disagree
the
on
biggest bubble in history, and it's the most global. End of story. Can anybody tell you, if you talk to anybody, tell you how much financial assets there are in the world now and how much there should be?
Yeah. Well, it
630
depends how you count the
trillion,
derivatives, right?
630 trillion, it's 6 times GDP, and normal would be 2 times GDP at 200 trillion. In other words, we have about 3 minimum, 400 trillion overvaluation in financial assets, which cost everybody money. Now, if you can keep borrowing against that and they keep going up, yes, you can keep this thing going a long time, but at some point, you can't have a house cost so much that even a strong upper middle class person cannot afford it.
You know what I think happens, Harry? It's like this, and we'll talk about this chart that's on the screen in a moment. But I think what happens is this, and this is what economists don't see: is people capitulate. They learn to accept less. This is what inflation does. It's insidious. It destroys people's standard of living, and so
Yeah, people
it would be like
will buy a smaller house. That's one thing.
yeah, absolutely. So it would be like this. Hang on, let me finish my example. It would be like this, and you alluded to it because you talked about Puerto Rico versus Miami, right? And how overpriced Miami is. So it would be like this. It would be like someone moving from Memphis, Tennessee, or Nashville, even, which is nicer than Memphis, to New York City, right? So they could have a big giant house in Memphis,
yeah,
and they move to New York City and they're living in a one-bedroom condo.
Small condo. Yeah.
In other words, they just learn to accept less as the standard of living goes down due to inflation. It's the same person, they're just accepting less. The standard of living has declined. That's what happens.
But the areas with lower cost real estate, like in the Southwest and Southeast, grow much faster. People don't just stay that way. Some people accept it, but more and more people don't accept it. And that's
I agree. And that's why we like those linear
out
markets.
Of California in the Northeast into the rest of the country.
Oh, I agree. Listen, that's why we invest in those markets, those nice linear cheap markets. Yeah, we like them. I agree. Hey,
and I'm in Puerto Rico. My house would be 3x in Miami here.
Yeah.
3x. Well, probably 4, but 3x minimum. Now,
and with the ability to do remote work, I mean, it's so easy to just live where you want.
Yeah,
you know?
well, and 20 years ago, I didn't move here because San Juan wasn't a first world city yet. San Juan is a good city now. It's a first world city. I mean, it's not New York or San Francisco, but neither are a lot of cities in the U.S.
Hey, listen, New York and San Francisco aren't New York and San Francisco anymore either. Okay, they've become shitholes.
I couldn't even visit San Francisco now. It's so bad.
It's a disaster. It's terrible. Okay, look, you asked me to share this chart. And this chart, for those on audio only, I just want to make sure you know what we're looking at. The chart is entitled Bitcoin Declining Megaphone Should Reverse Sharply Down by 68,000. What is this chart telling us, Harry?
Okay. So Bitcoin, I focus on Bitcoin for one reason, that the whole, crypto sector, not just Bitcoin, it's set to restructure all the financial assets on a global basis, and Bitcoin will end up being the digital gold. But that's decades from now. But this is
you like Bitcoin? Are you pro or against?
It's a leader in the next. Most of these crypto coins will fail. It's not that, but crypto itself is one of the next big things, particularly in financial services. So this is real, and Bitcoin is in its baby bubble. I actually compare, Jason, Bitcoin to the leader in the .com bubble just 22 years before it, Amazon, and they're almost identical. Amazon went from $6 to 136 in the baby bubble, just like, Bitcoin just went from nothing to 73,000, and then it crashed all the way back to $6, okay, in the 2002 tech bubble crash. So that first bubble was the first tech bubble. We just saw the second tech bubble, and this is part of a 45-year cycle I track every 22 years, 22 and a half approximately. So there's some method to this matter. And that bubble is bursting. The difference, Jason, is the government is extending this bubble and won't let it burst because they know Ben Bernanke started in 2008. He got so aggressive. He knows that when a bubble bursts, you get a depression, not a recession. And no politician, no Federal Reserve chairman wants to be in power
I
when
agree.
that happens.
I agree. And this, by the way, is one of the things I think a lot of the sort of Peter Schiff types miss. I mean, look, as much as we might philosophically disagree with it, I don't want to live in a centrally planned economy. I think the free market should run the economy. I don't really believe we should have a powerful central bank. I think it should be a minimalist central bank.
I agree.
But we have what we have. And the fact is, they don't want to see the economy crash either. So they're going to step in and do their thing, and that's what's going to happen. And a lot of economists just don't account for that. They just think that it's just math, that the market will just work on supply and demand and all that stuff, as it should. But that's not what we have. We have a centrally planned
The market happily accepts all these new financial assets that have been created on another and pouring more, all this money they've poured in the economy. $27 trillion, by the way, I quoted that earlier, never happened before, 9% of GDP on average yearly. That money has gone into financial assets, has inflated this bubble. That's what's happened. So this bubble at some point has to burst. The $1 trillion question that you keep asking is when. I think now only because they went into such extremes in bailing out COVID that they created that 9% sudden inflation, and they had to tighten hard, and they did, and we have not felt that yet. We're going to feel that first quarter the most, the first quarter of next year. So about 6 months from now, that's when I'll be able to look at my newsletter subscribers and say, I think it's going to be much harder than people think by then, but here's how much the tightening hit, because they went straight from stimulus to tightening. That's never happened in history before either. So the stimulus, I mean, worn off and they're tightening so that, we're really going to get the truth in the next 6 months is what I'm telling investors. I just warn people, be safe here. Stocks may look like they're going to keep going up. They could go down anytime. The first crash out of every bubble in history has been 40%, typically in a matter of 6 months or less, okay? So this thing could happen so hard that by the time you realize it's a crash and not a correction, you're already too far into it. I say this good time to be out of stocks generally, out of real estate you don't really need, especially speculative real estate, and see if this thing sets in, because I think it's going to set in. I think 2025 is going to be the worst year we see in our lifetime.